As part of your proxy statement filed with the SEC, you will include a summary compensation table. This is the grandmama, the 6 tables in your proxy that provide executive pay data about your named executive officers. Today on Zippy Point. I'm Brock Romanek. I'm a big fan of yous. Before I bring on Kyoko and Laura to explain further how to put together this table, let's run down some of the basics. Item 8 of Schedule 14A refers to Item 402 of Regulation SK. So Item 402 is going to be the basis for your summary compensation table, just like it is for all your executive pay disclosures. The summary compensation table is a prescribed table in Item 402C of SK. This is the centerpiece of your pay disclosures for your named executive officers. So who exactly are your named executive officers, otherwise known as NEOs? It's described further in another vid guide, a link to which is beneath this video. But the upshot is typically you'll have 5 of them, perhaps you might have a few more. The time period covered in the summary compensation table is each of the last 3 completed fiscal years. The general idea is that through this table you can get a complete picture of how much each of your NEOs is getting paid. That total column on the far right-hand side is key. The title for this table varies. Usually it's just summary compensation table, but it also might refer to the 3 fiscal years that it covers, but at least the introduction will definitely mention that there's 3 fiscal years covered. So there's mandated columns. You can't change the column titles, but you can omit a column if there's nothing to report it for any NEO that you have. This is under item 402A5. That you can omit a column. If an NEO is paid in a foreign currency, you convert that to US dollars using the exchange rates as of the date that the compensation is paid and describe the methodology for the exchange in a footnote. If you have an NEO who's also a director, you'll use a footnote to break out how much was earned for their director duties specifically. That's instruction 3 to item 402C. If you don't know an amount at the time that you're filing a proxy, perhaps the formula for salary or bonus hasn't dictated that amount at the time of the filing, you'll note that in a footnote indicating that it's not yet calculable and disclosing when you expect to know the amount. And when you know it, then you'll file a Form 8K under item 502F of that form. See my separate vid guide about those 8Ks. The ability to do that is in an instruction to item 402C2 Roman numeral 3. As you'll see as you look at item 402C, it's a very long regulatory requirement with instructions strewn throughout it. Speaking of footnotes, if you have so many that they become unwieldy, that's difficult to comprehend when you're trying to read this thing, consider what content you have might be better moved to the narrative discussion that accompanies the summary compensation table. You also don't want footnotes, of course, that have font that's too small. That makes it difficult to read. You'll definitely draw a comment from the staff and also earn the ire of investors. So let me cover the first 2 columns before I hand this off to Kyoko and Laura. The first column is the name and principal position column. There's no mandated order for the NEOs, but typically you have the CEO first, and then the CFO, and then remaining NEOs. NEOs who have left still will be included in the table if they're in an NEO. You're going to see my big guide about which NEOs who have left still might qualify NEO. But in that column, you can designate that this person is a former officer. So you use that as part of their title to reflect their status. If you have a new NEO, someone who came on during the year, you need to just include the pay data for the most recent fiscal year in the second column. The second column is the year column, according to this CorpFin staff interpretation. But then you don't have to annualize the compensation for a new or someone who departed during the year. This is another CorpFin staff interpretation that talks about no need to annualize. If you have someone who is an NEO this year, but because of the way the NEO determination is made, they weren't an NEO last year, but maybe they were 2 years ago. According to this CorpFin staff interpretation, you're going to have to include all 3 years in the year column for that NEO. If you're a newly public company and it's your first year of reporting under the Exchange Act, you're going to just include the last fiscal year in your table in most cases. That's instruction 1 to item 402C. A spinoff may or may not be treated like a company that just had an IPO. It's going to depend on some circumstances according to this CorpFin staff interpretation. And then under this CorpFin staff interpretation for mergers, there's no concept of successor compensation. So if the surviving company in a merger need not report on the compensation paid by the predecessor companies, the targets that disappeared in the merger. So let me go ahead and introduce Laura and Kyoko. Our guests today are Kyoko Takahashi Lin, a partner of Davis Polk up in New York, and Laura Heiman, Chief Counsel Executive Compensation of McKesson Corporation. They're going to talk about the summary compensation table. Kyoko's been a mainstay of the Proxy season conference that I ran for many years and a wonderful dear friend. And Laura, I've also known forever. She lives in one of my favorite places in the world, San Francisco, right by the bay. I'm jealous. I'm Brock Romanek. Today on Zippy Point.
Quick Zips by Zippy Point.
Quick and dirty. Kyoko, Laura, the summary compensation table, perhaps the heart of those voluminous executive pay disclosures, along with, of course, with the CD&A. And this is a terrible introduction.
No, Brock, it isn't a terrible introduction.
I'm keeping it anyways.
Keep it. Good plan.
Taking too many of these videos. Kyoko, why don't you start us off with talking about how important the summary compensation table is to draft the CD&A, or maybe it's vice versa?
So the summary compensation table is, for better or for worse, the table that investors, employees, proxy advisory firms, everyone looks at. Actually, it really, it comes first among all the tables. It's visually very arresting. It's supposed to document what the compensation committee or the board's decision is about compensation for the year. So it's really, quite important. The CD&A is really intended to describe the how and why of compensation. And it's supposed to provide the narrative background to the actual summary compensation table numbers themselves. But sometimes, the numbers by themselves don't tell the whole story. And so the CD&A is either the opportunity to reinforce what the numbers actually say, or, for many companies, if the numbers don't tell the whole story, they have to be very deliberate about making sure that their CD&A actually tells how they perceive the right story to be. So either way, this, the summary compensation table really becomes, the fulcrum of the executive compensation disclosure. I know, Laura, you have some thoughts just given your experience preparing both of those sections of executive compensation disclosure.
It's generally acknowledged to be true that the summary compensation table is the first thing that people turn to, whether it's your institutional investors and their governance teams, or the proxy advisory firms and their analysts who are putting together the analysis for them to make their recommendations. It has all the numbers that they want, and they just load it up into their analysis and they run with it. And from the summary compensation table, then they will start looking around at the rest of your executive comp disclosure. Is it the CD&A or other of the prescribed tables? So it is critically important that you get these numbers right and have very clear disclosure around them.
So Kyoko, what about the process of putting this table together? Do you have to fill out the other tables first to figure out what goes in the summary comp table?
So I do think that some companies fill out the other tables first, and then that feeds into the summary compensation table. I mean, a lot of the data overlaps. But I think that, for at least a lot of the clients that we work with, they start with the summary compensation table. There's a lot of spreadsheets and pivot tables that really back up what the summary compensation table does, because the data is not entirely overlapping. And again, I think coming back to the first point about how it's so important to make sure that the CD&A and the summary compensation table hang together, the numbers and the narrative together, really filling out the summary compensation table first, I think gives you that advantage of seeing, how will your story play out if you were just looking at the numbers alone, and therefore, what should we say in addition to or in reinforcement of those numbers in the, in the CD&A proper. One of the things that we always tell everyone, whether it's our lawyers or, our clients is, the summary compensation table, and really all the executive compensation table, it's very technical. The SEC has a lot of details, minutia of details here. And so really understanding, even if you feel like cold, what the summary compensation disclosure table, summary compensation table rules are, we always tell people, have a copy of the 402 rules by your side as you're going through the tables. One great online resource is the Cornell Law School's Legal Institute version, which can be obtained very, very easily. The print version of the Item 402 rules that's put out by CCH, a division of CCH, that's also very useful to have to. But one way or another, really having it sounds very basic, but having the rules right by your side is incredibly important. The other really important thing to remember is that there's the SEC rule. There are the instructions to the rule that follow the SEC instruction, the actual rule itself. Then there are CD&Is that the SEC has put out extensively that are all available online on the SEC's website. There's sort of gloss that the SEC has provided over the many years that have been collected by the American Bar Association's Joint Committee on Employee Benefits. And those can also be very helpful. They provide a lot of great tips. So there's a lot of places like that to look at, to really understand. And one thing that gets overlooked a lot is even the preambles to the adopting rules. They contain a lot of interesting information. And for some things, like perks, for example, all the really interesting information is all in the adopting release. So you really have to remember, to look at all these different sources in order to really understand how to put together the summary compensation table.
Yeah, it's funny you mentioned that. I do have a big guide about the dozen different ways that you can get guidance from the SEC, and I actually don't have the JSEB, the Joint Employee Benefits Committee of the ABA, in there because it is their meeting notes is where you get the guidance every year that the JSEB meets with the staff. The last 10 years or so, it's a while. It's probably not quite 10 years. Actually, there have been no notes that have come out of that meeting. They're sort of, the notes are sort of informally blessed by the staff. But it's only in this area of executive comp disclosure where you get this JSEB guidance, but it is very valuable. That's a great point to bring up.
From the in-house perspective, I think it's important that you do a very careful inventory. If you're doing this for the first time, or if you're at a new company coming in to do this, that you do a very careful inventory of all of the plans and programs that might have an implication in the summary compensation table. Because especially at an older company, there are a lot of legacy programs, there's a lot of things lurking out there that might require disclosure in the summary compensation table. So please do go out there and talk to your HR people, talk to the compensation and benefits people, find out what's out there so that you don't miss anything.
And Laura, I think you mentioned during our prep call that your comp committee gets basically a dummy version of the summary comp table.
Yes, well, yes, pro forma, not dummy. Yes, the summary compensation table, how that's going to play out is actually something of importance to a lot of compensation committees, I'm sure not just mine. And so we prepare a pro forma summary compensation table that's included in the meeting materials for every compensation committee meeting. It's not necessarily something they discuss, but it does inform their discussions, and it absolutely does influence their decision making.
Yeah, so Kyoko, why don't we go through column by column? Here's the table itself within item 402.
Okay, well, so a couple of threshold points to make before we actually go through column by column. One is, to Laura's point, you have to remember to include all forms of compensation. There may be specific exemptions from including some forms of compensation, but the vast majority of compensation looked at very, sort of defined very expansively needs to be reported in the summary compensation table. A second point is that the summary compensation table in the format that's been provided by the SEC, it has to look as is. People ask all the time, can I add columns? Can I replace columns? And the answer to all of that is no. You can actually delete columns if the column is totally not applicable to you, but you can't do that. That's the only change that the SEC really permits. And then the final point is just that all numbers have to be reported in US dollars. And so if you have an NEO who receives, their compensation in pounds sterling or euros or frankly any other form of compensation, you have to convert it and you have to disclose by footnote what your, or in some fashion, you have to disclose what your conversion methodology is. So that's just a couple of general points. But maybe just going with the first column. So name and principal position. This is pretty straightforward. Once you know who your named executive officers are, you list them all in this column. We do get some common questions that we get from time to time are, for the 3 highly compensated executive officers, do you have to list them in the order of compensation? And the answer to that is no, although that is by far the most common convention. And most companies, and what you do have to do is just remember to list all of your executives in the same order in all of your different tables so that it doesn't get confusing. Another question that we get a lot is, what do you do if a person changes their title in the course of the year, especially if they've changed their title since the time of year end and the time that the proxy actually gets filed with the SEC. And what we tell people in those instances, the SEC doesn't actually tell you, but what we think is probably makes sense is to report people's current title and then just indicate by footnote what their title was at the end of the year, just so that you can see. And that all even if it's totally voluntary, I think it continues to just reinforce the fact that what you're trying to do through both your summary compensation table and all of your executive compensation table is to make the story of your company, including any management changes or people's changes within the company, as transparent as possible, so that it makes it easy for investors and other stakeholders to understand. For the year, you're supposed to report 3 years worth of compensation for if you are a non-emerging growth company. If you happen to be an emerging growth company or smaller reporting company, you only have to report 2 years worth of compensation. You do have funny instances where someone may not have been an NEO for all 3 years or all 2 years that you're actually reporting, in which case you just report the year that applies, probably again with a helpful footnote. The SEC happens to have a particular rule, which I call the donut rule, or maybe, and I think others do too, where if you have a person who is an NEO in year 1 and in year 3, but not in year 2, the SEC still makes you report all 3 years, even if in theory there was a blank year in the middle. So that's really a few thoughts about the year. And then where it begins to get a little bit more interesting is the actual compensation elements themselves, starting with salary. Salary is really any kind of compensation that's paid on a fixed sort of basis. You do have questions like, well, what if I have an executive who defers their salary, or what if I have a person who receives equity compensation in lieu of salary? As a general matter, you are supposed to report the salary in the salary column. Although if it turns out that the person, for example, received an equity award electively, you would actually provide the full amount in the salary column, but then by footnote disclose that other forms of the salary was essentially received in another form, and there's some details around that certainly if those are your facts, it'd be worth sort of looking at a little bit more closely. But what you report is a salary that was actually paid. And so this is actually potentially an interesting year where, as a result of the pandemic or otherwise, if people have had changes in their salary, it might not be what people receive here may not be what you sort of think of as their full salary. It might be sort of reduced amounts or things like that. You don't do any annualization, no adjustment. You just literally report what salary the person actually received. Moving on, I'm going to take the stock awards column, which is that fourth column, and also the non-equity awards column, which is the seventh column, together, because they sort of they really go together. And then we'll skip to stock awards and option awards later, actually. But in layman's terms, this is really what we think of as annual cash bonus or other kinds of cash bonuses. As it turns out, the SEC's, their notion of what is a bonus is very specific. Maybe it's easier to start with what's non-equity incentive plan compensation. That is any kind of compensation that is basically a performance-based compensation amount, whether it's an annual amount or a multi-year performance period, where there's performance metrics that are essentially conveyed or communicated to executives that they are therefore aspiring to go towards. And if it's that kind of incentive compensation, sort of true incentive compensation, the way the SEC thinks about it, that gets reported in the non-equity incentive plan compensation column. Whereas if it's more of an ad hoc payment, like a retention bonus, a stay bonus, maybe a deal bonus, or if it's like, for example, a guaranteed bonus where the person is not actually trying to, they have an automatic right to a particular fixed amount of bonus, all of those bonus payments, or if it's totally discretionary, and there is no sort of underlying performance metrics per se, all of those kinds of bonuses go in the bonus column. And that's how the SEC thinks about it. Similar to salary, there are rules about, if a person defers a portion of their bonus or their non-equity incentive plan compensation, or if a person receives equity in lieu of those amounts, it follows the salary rules. You still report the full amount here, but that's what gets, but you might have a footnote disclosure that tells you that, oh, in fact, the person received stock awards in lieu, so they receive their bonus or their incentive compensation in a different form. But one thing to note here that's really important is you report the compensation for the year in which the compensation was earned. So for example, if a person receives a 2020 bonus, whether that's bonus in the SEC's way of thinking about it or it's incentive compensation, but if it's for 2020, but they happen to get paid it in early 2021, that still gets reported for this year in these columns of the summary compensation table. That is a different way, or equity compensation gets reported in a different way, and we'll see that in a moment. But it's important to know that essentially cash compensation gets reported on what we think of as sort of like an accrual basis, as opposed to on a basis that follows the year in which the compensation happens to get paid.
From the in-house perspective, what Kyoko is talking about is very important in that your bonuses, your incentive compensation, is not going to be determined until well after the end of the fiscal year. All of the numbers in the summary compensation table are year-end figures, and for that reason, you can't really load it all up into your platform until you are well into the process of the proxy. So our experience is that you are working very hard on the CD&A, and then when all these numbers come together, it could be almost close to filing time before you get the final figures, and then you load up all of these tables and let it go.
If I could just add one other point on the bonus and the non-equity incentive plan compensation, just because it may be relevant for this year particularly. So once in a while, you have an executive who declines, either all or a portion of their annual cash bonus for whatever reason. This year, it might be possibly more frequent just because of what's going on with the pandemic. The thing to note here is that if people decline their compensation before the compensation is essentially decided, then it does not get reported in these columns at all, or you put in like the reduced amount or whatever the final amount that the person actually receives is. However, if the committee makes their decision and then the person declines an amount or asks for a reduction of the amount, then you actually report what the committee's decision was, which is a very odd result. And so, if you want to report the reduced amount, you have to get the person to essentially decline what their bonus payment is going to be, or not, or what their full bonus payment is going to be before the committee makes a decision. That also happens to be important for tax reasons. This session doesn't cover tax, but it does also happen to be important for tax reasons too. So for both SEC reasons and tax reasons, just remember, if people are declining all or a portion of their compensation, they have to do so before the committee makes their award. Okay, so now moving on to equity awards. So now we're looking at the fifth and sixth columns, the stock awards column and the option awards column. So one point to note here is that what you report in these columns, one, it's totally driven by accounting. There's an accounting principle or an accounting rule called FASB AST Topic 718. That is what drives what gets reported here. This is not a legally determined number. This is an accounting driven number. And then the other point to note here is that for both of these columns, what you report here is what was granted in the year, not for the year, but in the year. And for many companies, what was granted in the year and what was granted for the year are the same. So it sort of doesn't matter actually for those companies. But for some companies, especially in certain industries, your equity awards for the year are sort of similar to bonus granted the following year. However, because it gets granted in the following year, you have to grant it you have to report it in next year's summary compensation table, not this year. So again, for cash bonuses, you report it on an accrual basis, and for stock and option awards, you report it in the year whenever the grants happen to have been made. Stock awards are basically what we think of as full value awards. These are your restricted stock awards, your RSUs. It doesn't matter if it's time-based or performance-based. Anything that's of a full share nature gets reported in the stock awards column. And you contrast that with option awards, where what the SEC says is if you have an award that has an option-like feature, meaning that the value of the award is based on the appreciation of your stock price, that gets reported in the option awards column.
If you have a performance-based stock award, you're required to put in the table the accounting-based figure for the probable outcome of that award. And again, that's all accounting-based. However, if that number is not the maximum that could be paid under the award, you need to include in a footnote the maximum value that could be recognized under that award.
So two frequent questions that we get. One is, if an NEO forfeits an award that they've just been granted that year because there's, for example, a termination of employment, do you have to still report that grant? And the answer to that is yes. The SEC has come out and said yes, because the decision was made to make the grant in the first place, even if they literally forfeit the award in the same year, you still have to report it. A second question that we get quite often, and this might be more relevant in this coming year, is what if the committee modifies the award in the middle of the year? And especially what if they modify outstanding awards in the year? Because this is all accounting driven, in the first instance, you have to ask yourself, was there an accounting modification? And not all legal modifications or contractual modifications are automatically accounting modifications. So you do want to discuss that with your accountants. But let's just say it is an accounting, something does constitute an accounting modification. Then that modification should result in an incremental accounting expense. And that is what you report in the summary compensation table. If you happen to be making a modification to a lot of or all of your historical outstanding awards, then that can actually result in a lot of aggregated incremental expense that you add together with the with the awards that you actually did grant for the year. And so that can end up becoming a much bigger number than you've anticipated actually. And that doesn't happen very often, but once in a while you'll have, a company will decide and say, what, we're going to provide for some kind of retirement benefit for all of our outstanding awards. And as a result of that, that's going to result in an accounting change for all of your historical awards, and that gets aggregated with the awards that you actually grant. So, there may be things like that can actually happen. If you have an executive, if you have an NEO who terminates their employment, and in that connection, there is a modification of award, for example, like if they would have lost their unvested equity, but instead in connection with the separation, the committee decides to vest their equity awards. There's a lot of special rules that apply in that context beyond the scope of this discussion, but just know that they exist and know that, that should be looked at carefully. Moving on to the next column, or to the column after that. So we already covered non-equity incentive plan compensation. So moving to the 8th column, which is the change in pension value and non-deferred compensation earnings column, a couple things to note at the outset. One, this column actually looks different for EGCs. For EGCs, they're only talking about what you only report as the non-qualified deferred comp earnings, not the change in pension value. So the change in pension value just gets ignored altogether. And for both kinds of companies, both for EGCs and non-EGCs, this amount gets added into what is a total column on the far right, but for purposes of determining who your named executive officers are for the year, it gets ignored. So it has sort of like an odd status relative to all the other columns that count for all purposes. So if you are a non-EGC and you're reporting both kinds of compensation for this column, your change in pension value is basically the aggregate change in the actuarial present value that the named executive officer experiences in connection with defined benefit plans, not defined contribution plans, but only with respect to defined benefit plans, whether that defined benefit plan is a qualified plan or a non-qualified plan. Again, not all companies have pension plans, but if you have them, or if you have a supplemental plan, this might be a column that can be relevant. You report here, years in which this column can be particularly relevant is if you have an executive officer who earns into a benefit like an early retirement benefit or a subsidy or something along those lines, that number can suddenly jump from, as compared to the prior year.
Another thing that can make this number jump, and we experienced this after the financial crisis, are changes in the assumptions that are used in determining these. If you have a big jump in this number, you're going to have to spend some time discussing why that number changed so radically and why it isn't really reflective of what the executive was paid for the year, but rather it's an accounting value.
The second part of this column is the non-qualified deferred compensation earnings. Two things to note here. First, this only covers non-qualified deferred compensation earnings. It does not cover, for example, if the company makes a 401k plan contribution, that doesn't get included here. That goes in the all other column, which we'll speak to next. And then second of all, it only covers above market earnings. It does not cover all earnings. And there are lots of earnings that a company's deferred compensation plan can have that are not above market, because above market really means that it has to be above an interest rate that the SEC rules get into in quite a bit of detail, or a preferential rate, for example. And if you don't have those, then you might not be reporting any earnings per se in this particular column. There's a different table where that gets reported, but not here. The final column that we get to before the total column on the far right is the all other compensation column. This is really a catch-all column for all the different other kinds of compensation that don't really fit neatly into any of the preceding columns. And again, just remember that you are supposed to report all compensation unless there happens to be a specific exception that you can rely on. That being said, the specifically enumerated items for this column are starting with perks and personal benefits. There's a whole other Zippy Point session on that topic, so we're going to skip that here, but that happens to be a
There's
big
actually
part
3
of,
dozen of them.
Okay. So that happens to be a different topic altogether. That happens to be a topic covered by other sessions. Tax gross-ups. So any tax gross-up that the company provides, which not many companies are providing tax gross-ups, but if you happen to provide one for any reason, that gets reported here. And that applies even if the underlying item that is being grossed up doesn't get reported for some reason. So all tax gross-ups automatically reported in this column. Something that you don't see very often, but it is part of the enumerated list, is any kind of company security related, or if you purchase company security, if the executive purchases company securities, any discount associated with that. Except it does not pick up employee discounts in connection with a plan in which either all shareholders can participate or all salaried employees can participate. So typically, even if you have, for example, like an employee share purchase plan, if it's a qualified ESPP, qualified under Section 423 of Internal Revenue Code, chances are you are not reporting that discount in this column. It's really, other circumstances that don't arise very frequently where you might have a requirement to disclose a discount. A big item that gets disclosed here that can really make a difference, and it can also really impact who your named executive officers are for the year, is termination-related payments. So any termination-related payments, this could be severance for an outgoing executive, potentially retirement payments, things like that. Those kinds of payments would go into the all other compensation column. And that gets reported whether it's been paid or accrued for the year. And that accrued aspect of it can be quite important, actually, because sometimes you have severance payments that go out multiple years, or at least some period of time well past the end of the year. But if it's been accrued for the year, it gets reported in the all other compensation column. The SEC has a couple of interesting rules around that. So sometimes if you have an executive officer receiving let's call it a severance amount, but the severance amount is subject to a 6-month wait because of the application of Section 49A of the Internal Revenue Code, that is still treated as accrued for the year. And so that does get reported, even if it gets paid, sometime in a different year altogether. On the flip side, if you have an executive who is terminating and their payment of severance is contingent upon their compliance with restrictive covenants, like a non-compete or something like that, then the amounts that are subject to the restrictive covenant, that portion of it does not get reported in here. That's not treated as either paid or accrued for the year. So that can make a difference, actually. Now, if you have executives that are out in California where they would not be subject to a non-compete or typically also non-solicits, then you won't have that. But for employees in many other jurisdictions in the United States, the ability to impose a non-compete may have a meaningful impact on whether or not or how much termination payments get disclosed for purposes of this column. There is a lot of interest in termination pay related disclosure.
Yes.
For a lot of reasons. And so, there's the summary compensation table where, again, what you report for purposes of the all other compensation column is the amounts that people actually were paid or the amounts that were accrued. If there are amounts that were not paid or accrued because, for example, they're subject to the compliance with covenants, they might still be reported elsewhere, or they would still be reported elsewhere because there's actually a whole other part of item 402, the rules there that are not, that's not covered by this particular session, but that do go into what the person's termination, what they actually received in connection with their termination is. And so, that could be, multiple years of severance. Doesn't matter if it's subject to a non-compete or any other covenant, all of that will just get disclosed over there in quantitative fashion. So, that it does go there, actually.
So there is a separate vid guide about the tables for severance and change of control payments, link to which is beneath this video. So what about narrative disclosure to the summary compensation table? We have this wonderful table with columns, footnotes, but then there's more?
So there is, a lot of the sort of quote unquote narrative, that goes into the footnotes. And a lot of the footnotes are mandated by the SEC. And we've referred to a few of those along the way. But many companies actually provide, voluntary disclosure in the footnotes themselves because they just provide a lot more color. I know, Laura, in the prep session that we were having beforehand, you were talking about how sometimes it's helpful to actually have even mini tables that go into the, that sort of expand upon the footnotes.
Right. I mean, I think you find there's a lot of narrative discussion in the footnotes to the all other compensation column, because that's a lot of tricky stuff in there. And I have noticed a lot of people will put in, when it comes to their perquisites or gross up payments, things that may be relatively routine, like company contributions to 401k plan or non-qualified deferred compensation plans, You may have Grossups, you may have financial planning benefits that you provide. People will provide little mini tables that just set out the amounts applicable to each of those so that people can easily see the aggregate number in the column and then see it broken out in a table in the footnotes. And I think that can be really helpful.
Agreed. There's also the narrative disclosure in addition to the footnotes that the SEC does require. And that can have a lot of interesting information as well. So the key thing, there's in fact actually a whole item, 402E, that talks about narrative disclosure. That narrative disclosure accompanies, in fact, both the summary compensation table and the grants of plan-based awards table. So it covers both items, but the key thing there is that if you have material terms as to your compensation programs and plans that really warrant additional disclosure, whether it's, for example, the existence of people's employment agreements or termination agreements or equity plans or things like that, that would really be where this additional narrative disclosure, which can sometimes be quite extensive depending on what the company needs and wants to say. That's really where all of that additional disclosure goes. That's oftentimes where the company explains, at least as a default matter, how their equity compensation plan works, what happens upon different kinds of termination or change of control scenarios, or all sorts of things like that. Employment agreements, offer letters, those kinds of things all tend to go into that narrative disclosure section.
And I know companies are allowed to do alternate summary compensation tables. So you have the prescribed table, but then if companies want to disclose something more to explain perhaps better their situation, they're allowed to do that. How common is that?
It's you do see it from time to time, and I would say that in certain industries it's much more prevalent than in other industries, because the SEC is just so prescribed in its format for how you have to present the summary compensation table. There are definitely some industries that just feel that the summary compensation table format does not lend itself to the company telling their story in numerical terms. And so they end up providing an alternative table. Usually that alternative table is actually housed in the CD&A and not in, not in another place, although sometimes you might see it following the summary compensation table. The SEC has made it very clear that they want the table to be, they want the table to be very clear that it's an alternate table and not to be confused with the summary compensation table, not to be read in lieu of the summary compensation table. And so for that reason, and also because it oftentimes makes more sense narratively to have that in with the hows and whys of your compensation table. If people do that, if companies do that, they typically tend to put it in their in their summary compensation table. I'm sorry, in their CD&A. But where you see that probably the most frequently is with financial services. So with a number of companies in financial services, especially the larger banks, for example, the way that they grant their incentive compensation, their cash incentive compensation, and their equity incentive compensation, they're really granting it at the same time, and it's for the year that just ended. So they think of their equity compensation as just another form of paying their incentive compensation. It just happens to be in the form of equity compensation. And with the SEC's prescribed way of doing things, they have to break it apart. So they get to report their cash compensation for the year in which that it relates, but their equity compensation, if it happens to be granted in the following year, it gets reported in next year's proxy statement, which is not that useful when you're trying to tell your compensation story for this year. So in that kind of situation, they might have an alternative summary compensation table that depicts in a tabular form how the compensation committee thought about that decision, and they will have their version of what they think the person's salary was, what they think the person's cash bonus was, and how they thought of the person's equity compensation. So that you do see that, and again, that happens to be a little bit more industry specific, but you can imagine that concept applying regardless of industry, if because it really comes down to how do you best tell your story in a way that makes sense to yourself, but also in a way that makes sense, obviously, to investors.
All right, so we have our grand finale, how to avoid common mistakes. Of course, Kyoko and Laura never make any mistakes, not that we're aware of. So what are common mistakes or pitfalls that people should look to avoid?
I think that, we've talked about this a couple of times, but people forget that that compensation comes in many different forms and ways, and they're gonna, everyone's gonna think of the obvious forms of compensation like salary and annual bonus and equity awards and things like that. But especially in the all other compensation column, where there's a lot of sort of little bits and pieces of compensation, people just might forget it. And oftentimes, the people who are preparing this disclosure are not the same people who know about the little bits and pieces of compensation that are out there, actually. So, it's only through a process does that even come out. And so that, that can happen. It's probably not a big point, but it's not uncommon for that to happen. So really having good controls over all the different elements of your compensation, and also really making sure that all the people who touch compensation and benefits, whether it's in legal, compliance, certainly HR, finance, that they're really coordinating is probably the best way to make sure that, all of that is coming together. Laura, you may have some additional thoughts, obviously, based on your role within your company.
Right. I mean, I agree with everything you said. I mean, it's, from the practical perspective, you should reach out early. I mentioned before doing a careful inventory of all of the potential plans and programs. Reach out early to the people from whom you're going to get this information after the end of the fiscal year. You simply can't get it earlier than that because all of this is fiscal year end based, right? But you're going to have several people in an HR organization, the people who administer your pension plan, who administer your 401k, non-qualified deferred comp plans. You're going to need to talk to them. If you have corporate jets, there's probably a group that manages the corporate jet flights and the requests and is doing all sorts of calculations for tax purposes and other purposes. You need to make sure that they know that there's a proxy calculation that needs to be done too for personal use of corporate jets. At my company, that's a security section. So they're completely outside HR. Your finance teams, you'll need to be talking with the people who do your equity accounting. Get in touch with them early because at the end of the fiscal year, they're all going to be super busy doing other stuff. And you just need to keep educating them about what it is you need, remind them, and then you have to start nagging them after the end of the fiscal year. That's very important. But it's a process of education from within the company as to what it is you need.
I think another thing that we see is the disclosure on equity compensation. The rules are very detailed. As I mentioned, they're accounting driven for purposes of the summary compensation table. And what you report in terms of equity, it actually flows through the other tables that we haven't talked about in this session, but there's, the grants and plan-based awards table, there's the outstanding equity awards table, there's, the stock vested and option exercise table, there's a lot of other tables. And so just really remembering that all these different tables actually have to hang together is really important to understand. And from a quality control perspective, just make sure that you're saying the same thing. This is particularly true, for example, if an equity award is modified in the course of the year for whatever reason. And this might particularly be true for this year, just given the possibility that companies may be modifying their equity awards. Just making sure that you track that through not just the summary compensation table, but all the other tables too, and make sure that your disclosure is consistent is going to be very important. And because the rules are so granular and particular, just really making sure that you do a close compliance check of that is just an important thing to do.
One small thing that is such a headache to deal with, but this is in terms of tax gross-ups. There are other payments that are making people whole for tax issues that you might not think of as a gross-up, but keep in mind, if you happen to have executive officers who are expatriates, who are living elsewhere, companies commonly have expats benefits programs, which they're enormously complicated, but which may involve extra payments to those executives to make them whole for the tax consequences of living in a higher tax zone. Those are gross-ups, and you need to talk about them. To be sure, a lot of investors they understand that they are very expensive, but the cost of doing those kinds of programs could really jack up your all other compensation. So you need to keep an eye on that too. One other thing from just purely practical matter of making sure your numbers are correct, we use SharePoint, but we have a SharePoint site and instruct everyone to load their backup to the SharePoint site. And we have people from our financial reporting group go through and recheck numbers that have already been proofed a couple of times, and they go through the backup and check them again. And I think that's something from a practical perspective that you really got to set up. It's invaluable. When preparing your footnotes for the summary compensation table, remember that you only have to do footnotes for the most recently completed fiscal year and not for all of them.
And I think one last point that we might just make about perks, recognizing that there are a number of other sessions on perks already. Perk disclosure can be tricky. It's not always easy to know what's a perk and what is not a perk. It can be also very sensitive, both to the company and to the individuals involved. And so, just making sure that you have a good handle on the perks, as Laura mentioned before, is really important. And I think one last broader point that I would make, remember that at the end of the day, all the information that's in the summary compensation table and the footnotes accompanying the summary compensation table, these are about real people. These are your executive officers. This is their personal information that the SEC requires to be disclosed. And so just being really sensitive about that and understanding, for example, who can see the documents at what time and what can be shared and what can be discussed. How do you frame something, especially again if something is particularly sensitive? Thinking about, is there a way to try to make the item of compensation as explainable as possible to investors, the proxy advisory firms, whether it's the amount or the form of compensation, and your other stakeholders like your employees. Just being really thoughtful and sensitive about that is really key. And even if your compensation programs have not changed, looking at it with a fresh set of eyes and just remembering that, many, many people's eyes will be on this compensation disclosure. Again, just coming back to the point that the summary compensation table, because it chronologically comes up first, but also because it so neatly wraps up in a bow a person's total compensation, just really remembering that is going to be looked at. It's so important to remember. And again, this is not just corporate disclosure. Like, this is disclosure about, a person's, compensation for the year. And so just remembering that, keeping that in mind as you're thinking about the preparation of the compensation and ultimately the disclosure that it goes, as it goes into an SEC filing is just something to remind yourself of, frequently.
Yeah, that's a great point. I have a separate vid guide about usability of disclosure and plain English. And it's, if you have a colleague that's not in your field, but that can be read in, there's nothing material in the disclosure. If you have them review a draft of your disclosure, and can they understand it? Can they comprehend what you're talking about? Is it too much of legalese, or did you just assume some knowledge on behalf of a typical reader? And you'll find out, from someone that isn't in your field more easily than if you have a colleague read it who does the same kind of work that you do.
I think that's a really good point.
So thank you so much, Kyoko and Laura. That was awesome. I learned some things. It was really good.
I don't know about that, Brock. You've said this so many times, but kind of you to say so.
Yes, I agree. Thanks for doing these. I think it's great. And Kyoko had lots of super great technical information. The last point is, call your outside lawyers. That's how you avoid mistakes too.
That's
Make
great.
sure make sure you're having your outside counsel review and do a rules check. For heaven's sakes, don't forget that step.
Absolutely.
So, well, thanks, Laura, for all your thoughts. It was, fun to put this together.